Thanks for joining us once again. This is Greg for Teslafaninsight. Our focused conversation today is the Fed nightmare that weighs on Tesla as it does other entities. So we all know, one way to articulate what's occurred is that China, as of 4 years ago, was holding $1 trillion worth of long-term U.S. bonds. Well, they probably bought more over time, particularly heading into the disaster, even when rates were low. Why were they buying? Because when large numbers or large amount of trade deficit generated revenue is sort of monetized, we get them, instead of repatriating the cash immediately, they're choosing to store it in U.S. securities in particular. The safest form is supposed to be U.S. Treasury bonds long. So this is what comes up with the nightmare that I wanted to discuss today. So yes, we have problems. So this is kind of a three-part show. The first part is framing, okay, what's the problem, right? The second part is possible solutions, even though there's a lot of people that, even with mega credentials, that have no idea what that solution might be. And I would say I have some, but not total. The third part is, what are the implications of 1 and 2 as we go forward? So I wanted to review first, what's the problem? By the way, this is Greg for Teslafaninsight. Thanks for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. So let's frame what the nightmare is. So what happens is that we can probably frame it best coming out of the banks, but just like China, the banks end up carrying large amounts of long-term treasuries. How far back did the Fed realize there was a problem / the big banks realize there was a big problem? Well, it goes back something like a year after the rates started rising. And what came up was, okay, what choices did the bank have once they figured out what was going on? Those choices were, one, why not sell everything? Which, given the rising rates that were very predictable, meant that they would have to realize losses that were pretty significant. But if they didn't sell anything, there wouldn't be any losses in theory, because you're still pretty liquid. You can cover routine withdrawals and you're fine. This didn't work out for Silicon Valley Bank, as you saw. So the problem I'm trying to frame here is, one, the banks can sell out because who would buy those bonds from you? The second problem that pops up, and why I think the Fed actually chose to bail everybody out, is the U.S. government has a fairly large size debt, and that debt is managed by selling more bonds going forward. So, for example, of our viewership, about 30% of you are based in California. Of that viewership, probably 10% of you have your pension tied up in CalPERS or CalSTRS, both of which are large pension funds that are based in Sacramento, some of the largest in the world based on the number of employees that rely on that for their retirement in California. Well, as of, call it 8 years ago, those retirement funds were already investing several $100 billion, but they're also getting $1 to $2 billion a month at least in new contributions from all the members of those plans. So the question that comes up is, in a well-structured fund, how are their investments structured? Well, the answer is a portion will go to stock. In theory, a portion will go to bonds. And then there might be alternatives, be it real estate, private equity, venture capital, et cetera, but those are like no more than 15% of that portfolio. So the question that's coming up then is, if CalPERS in good order says, hey, prudence suggests that something like 40% of our purchases every month have to be bonds. And of those bonds, at least half are likely government bonds. What's the problem with this? Well, the problem is that when you buy those bonds, according to Nouriel Roubini and many other economists, there's a problem that's popping up, which is if you know the Fed is going to raise interest rates, and we still have, in theory, between 2 and 3 points to go, how do you manage this situation? And what I mean by manage is that thus far, in just over a year, the bondholders have lost 29% of their money. In the case of the Chinese, that's $290 billion of a $1 trillion portfolio, as an example. So the problem that's popping up right now is I'm trying to frame it in terms of how a mutual fund might handle or a pension fund might handle this, because they're supposed to be very conservative in general and then work from that angle. Another example of this is what we saw from the bank. 90% of the money that Silicon Valley Bank collected was in treasury bonds, which they couldn't sell, so they had an interest risk, and they didn't have enough cash on hand to meet routine withdrawals. So where this leads us is into a giant question mark. Why would the Chinese or CalPERS or even banks buy any more bonds from the government when they know that they could predict they're going to lose, let's call it 20% in value over the next year as the Fed continues to increase rates? So the answer to that is that it is, I don't know. And here's why. There's all these covenants that require it to be a very conservative structural portfolio for the long term. What does conservative mean? Well, government bonds are the leaders, and then you can step down from that into blue chips, let's say, from bonds. But in general, you're trying to focus on things that are conservative, that are long-term plays. Great idea. This is where the nightmare for the Fed and Tesla pops up. This put your money in a safe place and ride it that way plan it's not really working. It hasn't worked in the last year. And based on the Fed continuing to raise rates, it just means there are going to be more losses that have to be cleaned up going forward. So the question mark is, what do you do? Now, one thing the Fed could do is just lower rates, and it will continue to improve the balance sheets and make people more comfortable with investing, because if you bought bonds and the rates are lowered, hey, the bond value, instead of falling, will actually start rising because they've got a good interest rate that's stuck there, and they could easily sell because people want those higher rated bonds in an environment where interest rates are falling. Why that's not going to happen is that because of a strong job market, a lot of bombs being sold in Ukraine, they can't lower interest rates because that might trigger a lot of inflation, which puts us in a runaway economy situation. So the problem that I've been trying to figure out for the last 3 or 4 days is what happens if, for example, number one, you can't, the bonds that normally sell at a regular pace from routine retirement accounts, bankers, etc., and even countries buying those bonds ain't happening. Guess what? All those people would end up sitting in cash in theory, but there are alternatives if you're in a small situation. You could buy gold or other assets, real estate, etc., that benefit from the rising inflation. And that allows individuals to be okay, but large institutions are not. I would not be stunned if of the 18 billion that Tesla has on hand, if half of that, uh, uh, those bonds, or half that cash isn't sitting in U.S. Treasuries that are long term. So they're taking losses too, and the fact that they're not selling them means they don't have to worry about it. Are they in a bad shape? Not really, and the reason is that when you're selling as many vehicles as Tesla is on a growing basis, you have a growing stack of cash, and you're not consuming that cash in terms of operations on a regular basis. You know, 25 to 30% margins means that, hey, you know, Tesla has plenty of capital to fund both its routine operations and the growth of the company. So this is one of the reasons why Tesla is actually a great buy as a stock, is that where the Fed is going and messing around with the bonds is impacting everybody, but some people are doing fine in terms of their sales, and therefore their cash position keeps getting stronger over time. So I'm calling this a nightmare because what I can't figure out is there's a lot of people that rely on the US government to be a stable entity. And that stable entity allows people to rely on the value of the dollar, also rely on the buying US Treasury bonds as a safe haven. Well, guess what? That safe haven isn't working right now very well. So the question mark is inflation going to drop into a reasonable zone so we can stay the same or lower rates? That would be the ideal scenario. Will inflation continue to rise, therefore forcing the Fed or causing the Fed to continue increase rates? And if they do that, uh, I would say that they end up with more banks that might have a run on it by people and that they have to bail out. So I think the Fed is in a tough spot because traditional economy relative to managing inflation calls for them, according to Nouriel Roubini, to rise another 2 points. And you can anticipate, um, based on the trillions of dollars of bonds that are out there, where things are going because all those bonds are being held in the portfolio of these large firms. So, for example, Credit Suisse was some somewhat damaged, obviously, by this circumstance. So overall, what I wanted to point out is we got a big problem going on. And how and where will the sacrifice happen to get this to work out? Kind of nobody knows right now, but we can expect entities that have people asking for their cash back to keep going out of business, much like Credit Suisse did. But everyone's signaling that people who have their money in their small or large amounts aren't going to be affected greatly. But I would say the efficiency is going to be there for large, well-funded uh, countries like the US, but it may be a problem for not as well-funded countries as they wrestle this problem. So where do we see this blazing on Tesla? As I just shared, they've got a loss of value that they have on stuff that they haven't sold yet, or possibly they could benefit from bailouts of banks that they may have money that's been placed into. We are in a precarious position, so let's not be surprised if we actually see if you will, the craziness to continue, and good companies and good stocks is where people will end up moving to and away from sitting there in a bank with a large amount of money. Also wanted to note to you that whenever you buy a stock or a bond, it's being stored on your behalf by the financial institution. If you're a very, very long-term holder, I'd encourage you to consider in a safety deposit box having them deliver the certificates to you and just put it in the box. Because as the banks start going under, et cetera, particularly the smaller ones, I think it's a safer place to have your certificates there rather than relying on it to be stored by the banks that are failing. Not that you won't get your money back, but just it puts you in a more stable position. At any rate, this is Greg for Teslafaninsight. Wanted to note our health tip today is on stretching. I just got sort of a stretching lesson from somebody who does it as a professional, and I'm working on how to do more stretching because if you're doing exercise, particularly lifting weights, it's going to move over and sort of bite you in terms of flexibility. So stretching of all type, highly recommended. Wanted to encourage you to consider that. At any rate, this is Greg for Tesla Fan Insight. Tschüss, au revoir, le Heath Road, Hoda Hafez, Zdravstvuyte, Ni Hao Ma, Kombanwa, and in Jamaica we say enough respect, walk good man. Thanks for joining us. Have a great day, and bye for now. Okay.